Chris Berry here. We're going to be talking about Berry's Bites, so bite-size knowledge as it comes to wealth and estate and tax planning for a safe, secure retirement. And so today I just got off the phone with one of our clients, and we're talking about our Castle Trust, which is a form of asset protection trust. So you might be familiar with the revocable living trust, which can avoid probate, control the distributions upon death. Well, what a Castle Trust can do is avoid probate, control the distributions upon death, but now build in asset protection, where we can protect against long-term care costs, where if we make it 5 years, then everything inside the trust is protected from that nursing home or Medicaid spend down. And then also we can protect against lawsuits. So we're talking about this Castle Trust, and we're talking about how to fund the trust, how to get assets titled in the trust. And they have about $600,000 of IRA money. And so what we're talking about was how were we going to move that money into the trust? And what we did is we had a conversation talking about the current state of the markets right now, plus the current tax situation, the fact that we're near the end of the year. And so they had some of their money invested in stocks, and as of today, the stock market took a little bit of a downturn, and some of their stocks took a little bit of a beating. And so what we talked about is that, well, you couple this with the fact that a lot of people think taxes are going to go up in the future, and that's just the way that the current tax structure is now. So 2025 marginal tax rates are supposed to go back up to what they were previously. So right now we're in a unique tax situation where marginal tax rates are some of the lowest levels ever. And a lot of people think in the future taxes will go up. So given that, it's a unique opportunity from a tax and financial planning standpoint to maybe look at paying the tax now on these pre-tax accounts, your 401ks, your IRAs, get out of that partnership with the Internal Revenue Service so that when taxes do go up in the future, you've moved money out of these tax-deferred accounts. So we're talking about that. And then also, because they had some of their money invested in these stocks that just took a dive, their IRA money just dropped. And so what we're talking about is this kind of unique window now with, well, if they have these stocks that just took a dive, lower the amount of IRA money, let's move it out of the IRAs now because they're at this artificially lower amount, and they're going to come back up because whatever goes down comes back up. Well, let's pay the income tax now while it's at a lower marginal tax rate because that's the tax rules now, and it's at a lower value because the stock market just went down. Pay the tax now, get it out of that partnership with the Internal Revenue Service, move it into the Castle Trust, and then and invest it back into that stock so that as the market rebounds or that stock rebounds, all of this growth, all this value is now protected inside of the asset protection trust, with the goal that once we've made it 5 years, everything inside of the trust is protected from that nursing home or Medicaid spend down. So what we've done is, from a tax planning standpoint, we've made a great decision to diffuse that ticking retirement savings tax time bomb, because marginal tax rates are scheduled to go back up. We've paid the tax now, gotten out of the partnership with the Internal Revenue Service, so we've taken care of a tax issue, done it at a time when the markets went down, so the IRA is valued at less than what it normally would be, and now we've moved it into the Castle Trust, and we've started the 5-year clock ticking for that nursing home or Medicaid spend down. So it's just a great strategy that's available, and especially you couple that with being near the end of the year. This is middle of or near the end of October here. You have an opportunity to look at doing one of these moves, moving money from the tax deferred accounts into an asset protection trust. You could do one part at the end of the year now, and then come January, maybe you look at doing another movement of paying the income tax on some of that IRA money, pre-tax money, move it into the trust, and then protect it. So it was just a great conversation. I wanted to share that. And this has been Chris Berry with Berry's Bites, bite-sized knowledge, talking about wealth, estate, and tax planning for a safe, secure retirement. Hopefully you enjoyed that, and hopefully enjoy our next upcoming episodes.